How much is a good return for a personal portfolio? If you have your own investment portfolio, or you're thinking about setting one up, it can be hard to find a good standard to compare yourself to. How much money are other people making on their investments? Today, we'll look at how there is no real standard figure and explain how a good return is simply getting equal to or more than you planned for. You cannot judge a return alone. You need to look at it in relation to the kind of portfolio you have. So, to put it simply, if you want to make a large return, you have to take on more risks. So, if you have a risk losing a large sum of money but are only seeing 8% returns at the end of the year, then your portfolio has underperformed. Sure, you didn't lose anything, you're up on the game, but you got no benefits from taking those risks. Similarly, if you have a long-term plan such as retirement fund or maybe a college fund for a newborn child, but you suddenly had a really good year, making 17% for example, then maybe your investment isn't as stable as you thought it was and you're exposed to more risk than expected. It worked in your favour this year, but who knows what is around the corner. When it comes to expectations, one of the most common numbers you'll hear is 10%. And it's not just because it's a nice round number, there is a historical backing to this. Over the last few centuries, stocks from the big stable companies normally pay out 7% per year in dividends. And if you look at inflation over many decades, it averages out at 3% annually. So together, this 7 and 3% give you 10% for any of you arithmetic fans out there. These safe stocks are called blue chip stocks, named after the blue chip in poker, which is the most valuable. Not all companies pay out dividends to their stockholders, since they might choose to invest in expansion or pay off debt, for example. But stocks that don't pay dividends can still increase in value since the business itself is growing. But most blue chips will give you something like 7% a year in dividends. They can fail, like Lehman Brothers and General Motors, but it's rare. So, what does this 10% really mean to you? Let's take the example we mentioned for a college fund for a newborn baby. If you took $35,000 and invested it when they're born, with a 10% return, you would have almost $200,000 when they are 18. And yes, $200,000 then will not be worth the same as it is today. It might give you only 60% of the spending power. But that should still cover a kid through private college. The most important thing though is to have patience and remember that returns are only real when you sell. Sure, you might get dividend payments that you can keep or reinvest, but the stock's inherent value is only found at the moment you let go of them. The same is true of real estate. You can worry about rising and falling house prices all you want, but unless you sell, that doesn't impact the money in your pocket, if we ignore borrowing related to your property's value, that is. So, a good portfolio can have a terrible few years so long as it performs well in the long run. Managing a portfolio is as much about managing your own expectation as it is anything else. For the loss side, look at the risk involved in each investment and understand what you could lose. If you cannot afford that loss, don't put your money into it. And for the gains, be realistic about what you will make. It pays to be suspicious. If a deal sounds like it will give you a much better return than anything else, find out why before you invest. If you would like more advice on investing of any kind, please give us a call at Holborn Assets, where we have over 100 UK qualified advisors who do this on a daily basis. So, if you're serious about investing, we look forward to chatting more soon.